everybody, it's John King, and today is Friday, the 21st of August. Probably your kids are back to school or about to go back to school, and I am super excited to come to you today with our market update. So first and foremost, a big shift this week that, well, it might be big, it might be small, who knows. But Wednesday morning, the Treasury Secretary, Scott Bessent, he announced that the Treasury was going to start buying more bonds, more Treasury bonds, and the market really, really liked that. Now, there's been a lot of back and forth since then, so I want you to understand what's happening here. And kind of what my title here says, the government is leaning against higher rates. So the Federal Reserve is in charge of short-term rates, how much it costs for banks to borrow money overnight from the federal government. The Federal Reserve does not control long-term rates. Long-term rates, the cost of borrowing money for a longer period of time, which a mortgage is a long-term rate. Long-term rates are determined by the bond market. The Federal Reserve decides how many bonds to sell. And the more bonds there are that need to be sold, the higher the interest rate is in order to attract buyers. And that's a problem right now, because the federal government is needing to borrow lots of money to fund activities within the federal government, okay? So lots of loans that the federal government is borrowing, is taking out to fund their activities, and those loans are pushing up interest rates in and of themselves. And then we've got inflation that's pushing up interest rates. We've got the issue with employment that actually is, maybe there's some problems with unemployment that is putting pressure downward on interest rates. But the bottom line is that the federal government just stepped up and said, we're actually going to continue borrowing a lot of money, but we're going to take some of the money we're borrowing and we're going to buy back our own debt. It's almost like a company saying they're buying back their own stock, and it's supposed to increase the stock value. So if you know anything about the stock market, companies can say, hey, we're going to take all our profits and we're going to use it to buy back our stock so there's fewer shares out there. Well, the government is basically saying we're going to keep loaning and loaning and loaning extra money, or borrowing. They're not loaning, they're a borrower, and they're asking for people to loan them money, but they're actually going to buy back some of their own debt to keep the rate down. It seems like kind of a circle, but the markets liked it. And the markets are basically saying, hey, that's a good sign that the federal government feels good about their long-term financial outlook. Maybe, or maybe the federal government is just trying to prop things up to lower interest rates in the short term. Either way, it's a slippery slope. And the government is clearly trying to push interest rates down in any way that they can. They cannot control the Federal Reserve. The Federal Reserve is independent, but the Treasury Secretary serves at the pleasure of the president. And so the president can certainly push him to pull levers to take actions that should drive down interest rates. Now, will it? I don't know. Because the problem is that even though the Treasury is buying more long-term bonds, which is helpful, and it will translate to some relief on interest rates, the problem is there's too many other factors that are going on. The biggest one is, what's the Fed actually saying? Because the Fed releases their minutes, their notes about what they talked about. And they release those minutes every 1 month after their meeting. So the Fed met a month ago, they released their minutes and it said, look, we got a lot of people thinking rates should be going up. So now we got arguments from the Fed saying they're going to raise interest rates. And so what happened today, this is not a Fed rate cut. This is not interest rates falling this week, Wednesday. It is the other department within the federal government saying we're trying to fight against that battle and we're trying to lower interest rates, okay? So it's a catch-22. We got two sides pushing against the same thing. Where it's going to end up, who knows? But the challenge, my fear, is that the more we have manipulation of the market, the more we don't let the market just solve its own problems, the more we're going to create problems down the road. We saw that even in 2020 when COVID happened. We had COVID drive down interest rates significantly. And that's great because the federal government wanted to spur on the economy. But that had a price. The price hit us in 2022. In 2022, we had interest rates jump up, and they stayed up for the long time. They stayed up for longer than they were down. And so there's a cost to these fixes. There's a cost to these market dynamics that we don't let the market actually fulfill. We don't let the market actually do what it's supposed to do. And so what we've got right now is we've got mortgage rates being pulled in two different directions. It's the same story I've been telling you, but now there's an extra factor. The good news is this factor wants to pull interest rates down, just like employment challenges have been also pushing to drive interest rates down. So that's really the big picture of what we're looking at right now. The reality is the housing market remains super, super interest rate sensitive. And when I talk about the market's made up of a bunch of people, a bunch of participants that are acting as the market. Like there is no like the stock market. Sure, it's a market, but it's people who are buying and selling. And so the stock market doesn't move. The people who are buying and selling in the stock market move the markets. Same thing with the housing market. When I say it's extremely rate sensitive, we're seeing rates right now that have pushed up into the high sixes. And that's giving people pause. That's making people step back and say, ooh, man, I don't know. I'm not sure if I can afford that monthly payment. And it's actually shifting a little bit more into a buyer's market. But I like today to distinguish between a buyer's market and an affordable market. Because let me give you an example. Let's pretend that Ferrari put all Ferraris on sale for 25% off. That's a heck of a deal on a Ferrari. And so it's a buyer's market because nobody wants to buy Ferraris as in this example. And so Ferrari says, we're going to lower the price of Ferraris. We're going to drop the price from $200,000 to $150,000. That is, I don't know what prices of Ferraris are, so I'm sure somebody's going to tell me I was wrong. But the theory is, wow, I can save $50,000 on a Ferrari. I should go buy one. Should you? Can you afford the payment of a $150,000 car? Like, sure, it's going to be way cheaper than the $200,000 car. It's a deal, but it doesn't make it affordable for you. And that's one of the biggest challenges that we're dealing with right now, is we're dealing with house prices are starting to come down in some markets and under some circumstances. I'm seeing sellers that are backing up and saying, you know what, I just don't want to sell my home right now because it's not worth it. And I'm not willing to sell it at a loss or not loss. How do you define loss? The loss is, the technical term is unrealized gains. Like, what'd you buy the house for? Sure, you bought the house for $300,000 and now you're able to sell it for $500,000 and you realize, no, I can't sell it for $500,000. I'm selling it for $450,000. That's not a $50,000 loss. That's still a $150,000 gain. But we're emotional beings. Humans think emotionally. And so emotionally, you feel like it's a loss because I'm selling my house for less. I'm going to wait until the price goes back up. Maybe, and you don't have to sell your house now. And I'm seeing more and more sellers do exactly that and not selling their house right now. But what are the implications? Well, the implications are that everybody says, oh my gosh, this is shifting into a buyer's market. Well, but the buyers only have so much leverage. If they push too hard, the seller just says, I'm going home. I'm not going to sell my house. It's no big deal. And so you can't push too hard. Your leverage could cause the other person to not want to play the game. Okay. And you got to have an opponent in order to play the game. It's like, if you're really, really good at chess, are you going to be able to slaughter everybody and make it not enjoyable? And is anybody going to want to play? No, nobody's going to want to play with you. So you may have the advantage in the game, but that could cause you to not be able to play games anymore. And that'd be pretty boring if you love chess. And so you gotta be careful about making sure you don't scare off your opponent. And so the buyer's market is definitely coming more so than a seller's market had been over the last few years. But the truth is, you also have to worry about qualification versus affordability. And a lot of people call me still today and say, John, how much can I afford for a house payment? And every time I say, you're asking the wrong question. You're asking me to tell you how much you're willing to write a check for every single month to live in that place. And the truth is, only you can decide that. I can tell you what you qualify for. I can say, hey, based on the mathematical equations that are provided in the rules and the guidelines, I see that you could qualify for a payment of X. That doesn't mean that you can afford it. I have no idea what you spend on your kids' sports. I have no idea what you spend eating out to dinner or paying for Netflix and going to the movies and all the activities that you like to do or travel. None of those things show up on your credit report other than if you have debt from credit cards, which is a whole other problem. So I can't tell you what you can afford. I can tell you what you qualify for. It is not the same as what you can afford. You have to determine what you can afford. Now you gotta be careful because again, you might say, well, John, I can afford $1,000 a month. I'd love to have $1,000 a month mortgage payment too. But that math doesn't work in today's market. So you have to balance and say, okay, what does it cost? Forget qualify for, forget afford. What is the price home that you need? What is the least expensive home that you are willing to move into? And what amount of down payment do you have to put towards that home? Those are the two most important things I need to hear from you. And then I can calculate, here's the truth of what it's going to cost to own that home. That's the first place we start. What is it going to cost to own that home? Then we decide, can I qualify you for it? And we decide, are you willing to pay it? Affordability is like beauty. It's in the eye of the beholder. You may have income that I can't count. In which case you'll say, well, John, I can afford that. And I say, yeah, but you won't qualify for it. You may spend money on expenses that I don't see. And so I say, well, you can qualify for it. And you're like, yeah, but I can't afford it. And so you have to have the third part of that wheel, which is what's it really going to cost? And I have so many people that I talk to every single day who say to me, John, I don't know what price I want. I want you to tell me first what I can afford. I can't. Well, then tell me what I qualify for. I shouldn't, because none of those numbers really matter. What we need to know is, what neighborhood are you trying to live in? What are the average prices of those homes? And how much money are you willing to put out of pocket to make this work? Then I can tell you what it's going to cost. Then you can tell me whether you're willing to spend that. That's the version of affordability. And I'll be able to tell you whether you qualify for it. Now, here's how things become more affordable. It's not because prices come down. Because prices coming down will, well, let me say this in a different way. It's not because interest rates are going to come down. Because if interest rates come down, you're going to think, oh my gosh, that's all I'm waiting for is for interest rates to drop, and then I can afford home ownership. How many other people just like you are waiting for that? A whole bunch. So if interest rates drop from 6.75 to 4.75, everybody and their mother are going to try and buy a home. And now you're stuck in a position where you're competing with a bunch of other people. And what happens when you're competing? Yeah, prices go up. And so you're going to end up in a position where you're going to pay more for the home simply because the interest rate came down and the price went up. We saw that in 2020 and we saw that in 2021. And so it puts you in a position where you spend more on the house, which increases your down payment and it increases your monthly payment. And so lowering interest rates does not make the house more affordable. Now, you'd say, well, John, what if prices drop? Well, the truth is, in this market, there's still a lot of more buyers that want to buy that aren't willing because of interest rates. And so what would cause a drop in this market? Well, what's causing right now prices to drop? Rates staying high. And so if prices drop a lot, it's because rates have gone up even more. And so that's not going to make it more affordable for you because you're going to have a lower price but a higher interest rate, and it doesn't impact affordability. So here's what makes it affordable. Your income going up over time. And we've been in a pretty stable market over the last 4 years, which is actually the best thing we could ask for when it comes to the housing market and actually feeling more affordable. My parents bought the home the home that I grew up in back in 1973, and they bought it for, I don't know, $38,000. You look at that today and go, oh my gosh, that's great, $38,000 for a house. I mean, houses are at least 10, 20 times that. They are. But the income was significantly lower. So for my parents, that didn't feel affordable because it was relative to your income. And today, we're looking at how people who bought the home 10 years ago bought a home for $250,000 or $350,000. Like, man, that must have been really affordable for them. No, because their incomes were lower. Because our income continues to go up. Inflation includes increases in your income. And so the income keeps going up. Your income keeps going up. And the longer that we can keep stability between interest rates and home prices, then your income will continue to increase and make that feel way, way more affordable. All right, switching gears really quickly, I want to talk about credit scores. Your credit score has never been just one number, but the credit scoring system is shifting. So I want you to understand that credit scoring models, there's many, many different models. There's only one set of credit score data, but three, because it's what Equifax, Experian, and TransUnion has, but all your credit card companies should be updating to all three bureaus with the same information. But there is a little discrepancies between each bureau. But what's happening is you've got the same data that is being interpreted using a different scale. I want you to think about length or height of something. You can measure how tall something is, how long something is using inches. We can measure it using centimeters. The actual length of the thing didn't change. And so something that is, and I'm going to totally screw up this scale, but something that is 4 inches is also 7 centimeters. I'm totally wrong, I'm sure. But the number 4 and the number 7 are different, but the size of the thing hasn't changed. It's the scale that you use to create the number. That's what the credit scoring models are. So you look on Credit Karma, you're going to get a number. That's the scale. That's the model that Credit Karma uses. It's not the model mortgage companies use. Mortgage companies' models were created and implemented, were adopted is the right answer, back in 2005. Those models haven't changed in the last 21 years. Until now. We now have the ability to use Vantage credit scores for your mortgage. It's in a pilot program. My company is one of the companies that's part of the pilot. And so I've seen Vantage credit scores now, and there's a wide range of Vantage scores compared to FICO scores. And it's pretty awesome that now we have 2 different ways to look at your credit, 2 different ways to evaluate it that pays attention to different things. And one example, and I'm just doing my research right now to understand this better, but one example is the FICO old model would look only at what your current balances are and a little bit about what your payments have been and your balance has been recently. The new model, the Vantage score, pays a lot of attention to how much you pay each month, and if you pay only the minimum, that's bad. I've been spending the last 21 years telling people it doesn't help your credit to pay extra every month. It didn't. We still have the old version, but now I can use the new one. And the new one, it does help your credit to pay extra every month. So there's some changes here. The most important thing I'll tell you is you cannot live your life to fix your credit score. You cannot purposely manipulate how you do things in order to have a better credit score. But what this does is gives us a separate option to look at to say, hey, maybe there's a way to tell the story in a different way. Now, this is on limited release, so it's only for conventional loans where you have at least 20% equity in the property. If you're doing an FHA loan or a portfolio loans or VA or USDA, or you're putting a small down payment, it doesn't apply. We have to use the FICO program. But the coolest thing is I get to look at your Vantage score and your FICO score and pick whichever one is going to give you the better deal. That's really, really good, and a lot of lenders can't do that. They will be able to down the road. Right now, only a few lenders are piloting it, and I'm proud to say I'm one of those lenders. So anyway, as always, if you have any questions about anything, please feel free to reach out to me. I am here to earn your business. I am a mortgage lender. That is what I'm paid to do. I don't get paid from YouTube, but if you share and subscribe and like my channel, maybe I'll start getting paid by YouTube. But the truth is, I am paid to take great care of you. So hopefully I'm earning that trust. If you feel like I've earned that trust, and you or someone else that you know is looking to purchase a home, refinance a home, take out a home equity line of credit, just want to talk about mortgage options, I would love the opportunity to have that conversation. Hope you have an absolutely wonderful weekend, and we'll talk to y'all soon. Bye-bye.